Hey guys, welcome back for part three of me revealing my entire stock portfolio. I wanted to take a second to say if you haven't watched the first couple of parts yet, it's probably best to go back to those videos before jumping right into part three. And also, just a plug, if you like this content, you're enjoying these types of videos, please consider subscribing to the channel. We're currently sitting at 19 subscribers. So let's get to that 20 mark and start going for the next milestone. I really appreciate all the support that you guys have all been giving me with the views and everything. Um, just if you are interested in going through all of this slide, you can pause the video, but I'm not going to go into this too in depth. Just a couple disclosures here. I'm a Canadian investor, so I own both Canadian and US stocks in my portfolio that you're going to be seeing here today. And I'm also primarily a dividend investor, as you can see from the part of the portfolio I've revealed so far, only a couple non-dividend paying stocks. So you can kind of expect that trend to continue as I primarily focus on capital being returned and then reinvested and compounding my portfolio through those means. So we're going to get right into stock number 17 in my portfolio today. Stock number 17 is Canadian Apartment REIT. So Canadian Apartment REIT is a very big landlord, I believe the largest residential landlord in Canada. It's an $8 billion market cap. They have, I believe, $12 or $13 billion of just gross enterprise value before debt. So a huge residential business in Canada. I believe they also hold about 10 to 15% of their assets in the Netherlands, lots of student housing and stuff over there at very, very low interest rates that they've been able to lock in over the last couple of years. The company is at about an $8 billion valuation. It does make about $100 million in funds from operation a quarter, give or take. So just doing some quick math, they tend to do 400 to 450 million in profit in REIT terms. So this stock's trading at about, call it 19 times trailing funds from operations, which honestly, historically speaking, is cheaper than this stock has been for a while. Canadian Apartment REIT is one of the highest quality REITs in Canada, has been trading closer to 25 times for a number of years. And just how expensive it is from a cap rate perspective to get into these kinds of properties, it's very hard to find replacement value at a higher return than 5% a year, believe it or not, in the markets that cap rate tends to play in, which is like heavily in Toronto and in major cities as well. And we'll get into that a bit more. Just a couple call outs here. So total amount of shares has been relatively flat. They're actually looking at taking that down now since their stock price went down, as you can see. Over the last year to 2 years, we're all the way up at $55 to $60, kind of before COVID and at the beginning of COVID. And because mostly interest rates, the stock's really trended down. But we do pay a 3% dividend here, and the company does have like a free cash flow return of about 5%. So they're also investing in the business, buying back shares starting now. But before that, they were also doing strategic acquisitions. Let's just talk a bit about the backdrop on this company a bit. One of the things in Canada specifically is we have a huge shortage in housing. There's a lot of pressure not to build incremental housing that goes into kind of the green belt across Canada and across Ontario, just for environmental purposes, not wanting to go into new areas and build out of the big cities is causing a lot of pressure and demand without the supply. There's also issues on how much red tape there is to build in many of the large cities in Canada, and how many taxes and fees and issues there are on that front. So development's really slowed down, and it's really been advantageous for the people with existing properties. They can do annual rent increases perpetually pretty much. And it's just a good environment for residential real estate owners. And that's why the valuation on these stocks and these assets are so high. In addition to the current landscape, you also have an increasing population. Immigration's growing 2 to 3% of the total population a year in Canada, primarily in the main cities where CapREIT operates. A growing seniors market, lots of international students returning after COVID, and then reversal of household consolidation. So something culturally in Canada that's a lot different than the US is given the geographic nature of the country, most people don't get up and move to another province or get up and or move to another state like in the US. The vast majority of people under 35 live within a short drive of their parents' house. And during the pandemic, we saw lots of people move back in. There was no reason to have their own house, and stuff like that. So we're kind of seeing a big reversal of those people who've been at home too long now because they didn't move out during the pandemic, all moving out at the same time. In terms of their capital deployment strategy, this has kind of changed a bit recently. So historically, they've acquired lots of kind of economy level residential buildings, and they'd renovate them, increase rents, create a lot of value that way. Now they're really focused on new construction, new apartments, and you'll see that in their acquisitions a bit. They're also focused on building out their um, I don't want to call them trailer parks, but assets where they own the land and then they rent the land to other people. And this generally has higher yields. It's also somewhat safer. They call it low risk because lots of the money that's being paid to them is straight from the government for lots of these customers. Currently, this is about 5% of the business, so I wouldn't over focus on it. But it is an area that they find attractive returns on investment, and they're looking at expanding how much of this portfolio they are comfortable having as a percentage of the company. And then lastly, this is another new one. Given the high unit price of like 25 times, they used to not really buy back shares. They used to focus free cash flow on acquisitions and stuff like that. But as the stock price has gone down into the low 40s, now it's in the high 40s, but this presentation is from the low 40s, they started doing a buyback program, and they bought back some shares last quarter, expecting it to continue this quarter and throughout the year until the stock price returns probably at least to the mid 50s, back where they believe is closer to fair value. So lots of those things I like to see. The focus on high return assets in their portfolio that they're underdeveloped on, focusing more on new construction right now, and then buying back shares with remaining capital all makes sense to me. This is just a quick little image showing some of their recent acquisitions in the last quarter, and just the type of assets they're buying. So this one's in Quebec, this one's in Alberta. They are just like much higher quality. You can kind of see stainless steel appliances, accommodations, furnished, nice floors, pot light ceilings, stuff like that. So not all of their assets and business are in properties that are this nice and modern, but it's definitely where it looks like they're focusing lots of their acquisition budgets currently, which is good to see. And then lastly, just as I mentioned before, they bought back about 2% of the company over the last quarter, it looks like. So as they continue to monitor the unit price, if they see returns on their stock in terms of like free cash flow multiples that they can't find in the market, after paying the dividend, I think it makes sense to return capital to shareholders through share buyback. So that's another thing that I don't mind that they're executing and doing right now, and I'll continue to monitor, how much capital continues to go to this depending on what the stock price is at. But they've been pretty swift and diligent with buying at prices that they feel are too low, and then when the stock price goes up, they stop buying. Okay, going into the next stop. Next stock is Pizza Royalty Corp. So I talked about this on a separate video I did about food royalty corporations in Canada. If you're interested in that video, you can go and find it on my channel. But this is a company that owns royalty rights for the Pizza brand in Ontario and the rest of Canada, except for Alberta, where the brand is Pizza 73. But it's essentially the exact same business, just different branding. The stocks performed really well. So take into consideration that over the last year, the general market's been down 15 to 20%. Pizza royalty, inflation doesn't really hurt them. If anything, it kind of fuels their business as more people trade down to more affordable food options. So they've seen 17% stock appreciation, plus they're paying a 5 to 6% dividend. So this stock over the last years created a total return of 20 to 25% for me, which has been great. Once again, I mentioned this in the royalty video, but one of the great things about royalty funds is you really don't need to worry about cost of labor going up, cost of goods going up, cost of rent going up. As long as the business is sustainable and you keep the doors open, you're just taking a cut out of the top line. So it really simplifies the business model. And as prices go up behind all of these costs of goods going up, and inflation increases the prices of pizza as an example, you're just getting a higher cut of absolute royalty as the price of a pizza goes up. You're making more pennies per purchase. So if anything, in markets or businesses that aren't too impacted in volume by recession, as prices and inflation occurs, they actually tend to benefit. And I've seen that on a lot of my royalty companies this year. One thing that's interesting just to note is the company gets about 6% of top line sales from Pizza. So think all of their business outside of Alberta, I believe, and then 9% of Pizza 73, which is inside of Alberta. So it's a bit of a mix shift there depending on what provinces are doing better. But generally speaking, the vast majority of the companies in Pizza, which is the 6% royalty stream that you're getting. I believe another soundbite about their business is about 10% of the company's locations and revenues are done in kind of like specialty locations. So think sports arenas. If you're going to watch a hockey game or a soccer match, they kind of have deals with those facilities to provide exclusive like pizza. So that's a bit of a different type of business. You kind of have the demand come to you. You don't have to earn it as much, but then also it's a bit cyclical depending on the season and how many people are going to the stadiums and stuff like that. But the rest of the 90% of the business is just takeout, walk in, typical pizza shops on the corner, stuff like that. They have over 700 across Canada, so pretty big presence. Just looking at their same store sales growth, they obviously needed a bounce back after COVID, where their walk-in business just got destroyed. But overall, we've seen 2 years of pretty good growth here. Or I should say more 1 year. The last year, 14% in 2022. In the third quarter, 16% year to date. So that's probably a better number. And then at least in the third quarter, we saw overall growth in 2021, whereas year to date was still trailing a bit as Alberta recovered from COVID. You can also see, obviously, in both years, we're seeing a much stronger comeback in the rest of Ontario and Canada than in Alberta. So that's another thing to keep in mind of. Not sure if Alberta didn't dip as much with Pizza 73 to begin with, so there's not as much to come back from, but I'm not too certain on the details there. Okay, going into stock number 15. Stock number 15 is Scotiabank, which is a bank here in Canada, but also has a bit of a global presence, which we'll get into as we talk this one. So this bank is frankly super cheap. And I know banks tend to trade relatively cheap, but this bank does about $8 of trailing EPS, buying back shares, paying a 6% dividend, has increased the dividend for 50 straight years or 40 straight years, something like that. So I know they have some problems on their business that we'll talk very briefly, but this is a big valuation play for me. I like the PE and the return on my capital by investing in a bank like this. And over the long term, all the Canadian banks have kind of taken turns, which one's trading the cheapest, which one's the most expensive. And they always end up perpetually growing at about 10% CAGR over the long term. And then their values correct to 10, 11 times earnings, which given the resiliency of these companies, I even think that's cheap when they're trading at quote unquote fair value. So we'll get into this one a bit. 4 of their main business lines here that they kind of summarize in their quarterly earnings. About 50% of their business, give or take, is Canadian banking, relatively stable market, lots of mortgages, business loans, stuff like that in a developed market. 15 is wealth management. 20 is global banking and markets, which we'll get into a bit. And then 24% is international banking. So four different divisions. Half the business is specifically done in Canada. 15 global wealth management. I think they have a bit of US in there, but it's kind of all over the place. And then in the other businesses, they do have a big presence in South America. So we'll talk about that a bit. And that's kind of one of the reasons their stock's been weighed down a bit. Before getting into that, just highlighting what I was mentioning before. So over $8 of EPS. This stock's trading under $70 right now. So literally trading at about 8 times earnings. And their dividend has increased every year. They have the last 11 here, but it's been decades. They've doubled it over the last 10 years, up to $4 a share. So you're getting a 6% yield, but they're only paying out half of their EPS. So you're still getting a lot of money being reinvested in the business for growth, buying back shares as you're getting 6% out of the business every year. So once again, I just think it's a great valuation right now for this business. Going through some of their South American business. So yeah, they have banking units in Mexico, Colombia, Chile, Peru. And this is really an area they've been investing a lot over the last few years. They've made a lot of billion-dollar acquisitions to bolster their position in lots of these markets. And this is really where they've seen a lot of weakness on their business. Their return on equity is 11-12%, where their return on equity on the Canadian business is 25%. So it's really weighing down their return on investments and return on equity as they continue to mix more of their business to Latin America. At the end of the day, in my opinion, is for the amount of their business overall that's in Latin America, you could write it down to zero and this company would still be trading under 10 times earnings. So I know they're having some issues. It's still a very profitable unit, just not as profitable as they'd like. And loan revisions aren't as great as they'd like. I think just from a macro standpoint, with the strength of the US dollar and things like that, and some government policies and elections and stuff like that, it's just been a lot more unstable down in these markets than they were hoping for, at least over the short term, which has really weighed down the performance of those markets and their business. But ultimately, they're still making significant amount of profit and cash out of this business. And I think they're trading as if these businesses are going to perpetually lose them income from their super profitable global wealth management and Canadian businesses. So I'm comfortable holding onto them and having this presence down in South America. I don't have a lot of presence across my entire portfolio in South America, so I don't mind holding it. I wish it was doing better, but once again, it's just short term. Hopefully over the long term it picks up and it really accelerates the performance of the business and the stock too, I guess, even though I don't care too much about the stock price as long as they keep increasing the dividend. Actually, it's probably a good thing if the stock stays down so they can keep buying back shares and so on and so forth. All right, going into the next stock. So Meta Platforms at number 14. Now, I'll tell you that if we were doing this video a year or two ago, Meta would not be number 14. It would definitely be a top 10 position. But this company has absolutely got destroyed over the last year, 18 months. As you can see on the 52-week range even, the stock used to be $330 a share US, now down to $136. It's actually jumped 40%. It went under 100 there, so very volatile stock. This one's honestly painful to talk about, but I'll try not to ramble and rant too much throughout this. Going through their business performance, their advertising business, all of digital advertising and advertising as a whole has kind of gotten hit lately. Lots of factors. Obviously, inflation just slowing down the business cycle. Lots of crypto advertising and like unsustainable small type of COVID businesses that were pumped up over 2021 had to back away from their marketing budgets. So we've seen the digital ad space get hit. We've also seen like Warner Brothers Discovery and Paramount CEOs talk about how their ad businesses on TV have less and less demand, and they're in an advertising recession. So I'd say on their advertising business, they've held up, you know, as expected. Like not great, obviously. Looking like Q3 23 versus Q3 here, sorry, 27 versus Q3 here, 28. So they're down a couple percent on advertising, but nothing terrible given the state of the overall market. They're probably growing share at that decline. What's obviously destroying this business's stock and profitability is their Reality Labs, which is at 285 million in revenue and 4 billion in loss for one quarter. It's insane. And I won't go into this too much because I can spend an hour just on my thoughts on what Meta or Facebook rather is doing with their investment and how they allocate their shareholders' money. But you can kind of see it in these visuals. Year to date, even though the business is down on EPS, on revenue, of course their capital expenses are double, which is terrible cost control. And then their EPS has been impacted obviously by that dynamic of slightly less revenue paired with a dramatic increase in costs. So I guess where I'm at with this company is if you were to take out the Reality Labs segment of their business, this company's trading super cheap for a low teens multiple for probably one of the most efficient and productive ad businesses and advertising businesses in the world with a lot of growth ahead of it. So I'm just hoping some blind faith that they kind of correct spend and CapEx on that side of the business, flow it out over more years, continue the pet project, whatever. But I'm really invested in this because of the ad business, and I just think it's too cheap to let go of here, given the multiple of this business without Reality Labs. Going into some of the things that I think are very valuable on Facebook. So they have almost 3 billion daily active users. That's just insane. If you just think about the amount that can be monetized and the value that they have by having, let's call it 1/3 of the world, it's even more than that, on one of their applications on a daily basis. That's a lot of eyeballs. That's a lot of attention. And that's very valuable and can probably continue to be monetized farther than it is today. On a monthly basis, we're talking like half the world on a Facebook app. So they just have tremendous scale, tremendous opportunity as they innovate and they bring new ways to advertise or new ways to drive commerce through their platforms or business relationships with WhatsApp, whatever it may be. They have a lot of under monetized assets, in my opinion. So I just think there's so much opportunity given the valuation of this company for their core business. I wish they just burn Reality Labs to the ground and pretend like it never happened. The stock would probably double overnight. But it is what it is. And I just hope that the amount that drags the company's CapEx and EPS is just, right sized over the next couple of years. And we can get back to the core company that everyone who owns the stock initially invested in. And then lastly, forgot about this slide, but this is just to share long term. I'm just super bullish on their ability to drive revenue per users across the world. So I remember looking at Facebook reports 4 or 5 years ago, and in the US and Canada, they were monetizing in the teens, so like $17, $18, and even like Europe was like $4 or $5. And even since then, they've been able to really drive up how much they're monetizing lots of these other areas of the world. I remember the rest of the world used to be $1. So I just think as they continue to learn how to monetize users to a greater extent, up to $50 in the US and Canada now, I think it's just a matter of time till obviously these tools get rolled out to the rest of the world, but also economies and businesses in the rest of the world develop as well and get to a place where it's just more demand for digital products and it's more digital advertising to fuel that demand. And I think whether Europe and Asia Pacific get to $50 a person or not. I think there's a lot of room between 5 and 50 and 15 and 50 for them to kind of continue to drive monetization on a per user basis. Okay, going into number 13, Visa. So Visa is one of my favorite companies that I'm planning on buying more of in 2023. I actually did like a very long 40-minute video on why I'm buying Visa in 2023. If any of you guys are interested in that, just visit my channel and it'll be there. Probably one of my best received videos so far. So Visa right now is trading at $220 a share. So not a cheap stock by any means. I think they're earning about $8 per share. So I'm just doing some math in my head. They're trading for like a high 20s multiple, let's call it. But this company has been such a strong performer and such a great business. So just going through some of their numbers, 30 billion in net revenue. They turn half of that into net income. They're truly a global company, tons of payment volumes, and they return all of their value that they create in terms of profits to shareholders annually through dividends, dividend increases, share buybacks. So just a tremendous company, in my opinion. Obviously, they're a network of networks and they're a payment processor as a business. So they have a lot of avenues on top of just riding organic growth as more cash payments move to card to expand and accelerate their business. So this is just a few of their areas. Consumer payments, looking at new ways they can have consumers use Visa to pay. So obviously things like tap to pay, click to pay, just make it easier for consumers to use card than cash. New flows of money. So they're looking at, other than a consumer going to a store buying something with a Visa, where else can they facilitate payment processing? Whether it's moving money from peer to peer, governments to consumers, just lots of different avenues. I know people paying their rent on their credit card is something that they're exploring with lots of large landlords in the US, and just stuff like that to increase the amount of dollars that are moving in the economy that they can get their hands on to take a very slight sliver of in terms of revenue. And then for their banking partners and everything like that, value-added services that they can increase how much they're charging them for their services, whether it's risk and identity, different types of solutions. I'm not going to pretend to know about some of these ventures in depth, but just opportunities to kind of continue to partner deeper with their banking partners. So this just goes to show how strong this business and how much growth they have ahead of them. They just continue to grow and ride organic trends year over year. $11 trillion in payment volume in 2020, 13 trillion in 21, 14 trillion in 22. And you just see it flow down very nicely from total payment volumes to net revenues of 22 to 24 to 29. And it's just been growing at this like clip of 20, 30% for pretty much a decade now. And they take all of that money that they make in revenue, so much of it flows down to the bottom line into EPS, $5, $5.60, $7, and then this year will probably be $8, $8.50. And they just take that money and return it to shareholders. So this is just a chart of the buybacks they've done every single year, bringing the share count 12, 13 years ago from 4.5 billion to 2.1 billion. So a great job of just doubling the share each investor owns of the company if they just held the company for the last 13, 14 years. So yeah, I just think it's expensive stock on a multiple, but if I'm going to pay a high 20s multiple for a stock, this is one of the best stocks in the world and best companies in the world, in my opinion. And they've proven their ability to return cash to shareholders and be shareholder focused. So I'm definitely holding this stock and will look to add on it throughout 2023 if any price dips happen. Going into the last stock we'll talk about today, the Keg Royalty Income Fund. So this is another royalty company. You guys are kind of getting the gist of lots of the types of companies I'm investing here to maximize kind of the cash that I'm getting on a month-to-month basis to return back into the portfolio. But this is very similar to Pizza Royalty, obviously, just a bit of a different business. This is a sit-down business, higher-end business that has a much different clientele than Pizza. A company like the Keg could actually get hurt during a recession, given the average price of a meal versus ordering a pizza or something like that. So that's something to watch out for me. But ultimately, I think this is still a great business. It'll do fine long term. And that's why I'm continuing to hold it here. Looking at the stock, you see that 7% plus yield. I think some of that element of the higher yield is just the fact that it is a sit-down business, maybe a bit more cyclical due to a recession in the economy. But ultimately, the stock has also held up really well. Past 1 year, market's down 20%, stock's up 7%, also got a 7% dividend on that. So 14% return, outpaced the market by over 30 points. So love to see it on these royalty companies. They've really helped me out over the last year, offset some of my meta losses that I've had on that portion of the portfolio versus a year ago. So the Keg, similar deal. They get a 4% cut of gross sales at Keg restaurants in Canada and the United States. There are actually a couple United States franchises. So we'll go through that in a bit, but this is primarily a Canadian company. Oh, I didn't take off the copy paste here, but what this is essentially saying, if you read through it, there's 10 locations in the US, I think some in Virginia, one in Texas here, but broadly speaking, this is primarily a Canadian company. Over 90% of the locations are in Canada. You're seeing 50 in Ontario there, 20 in BC, 20 in Alberta. So pretty national business in Canada, but primarily Canadian-based, dipping their toes in the U.S. I think they're growing there a bit. When I first invested in the Keg, maybe 4 or 5 years ago, I think they had 2 locations in the U.S. and they had 100 total. So now they're at 107 and 10 in the U.S. So they've definitely mixed more towards the U.S. as an area for growth, and we'll see if that continues. Now, just a visual to show what I mean in terms of how these royalty funds work. You can kind of see just at the bottom here, it's literally their revenue is just taking the total sales of the restaurant every quarter, multiply it by 4%, and that's the portion of revenue that we're entitled to as owners of the Keg royalty fund. And then after just the top line royalty income, you'll see down the income statement, you have like very minor SG&A, and then the biggest expense, I guess you can call it, is just tax on this revenue, which is essentially gross income after some of those smaller expense lines. So it's essentially just royalty income, very minor operating expenses to run the fund, and then you're just paying your tax on this, and it's getting paid out to shareholders every month. You can see every month they paid out $1.1 million to the fund, which over time is 100% of the money that they're getting. So in this line here, you can see since they launched the fund, I think 15 or 20, probably about 20 years ago, they've distributed $224 million they've generated $224 million in royalties, and they've distributed $223.3 million. So this is just money in, money out from people buying food at the restaurant to the fund to your pocket, and you're really seeing that come to life here in terms of the percent payout rate on a month-to-month basis and year to year, as it's just super consistent. As sales go up, the payout will go up very soon after, as they don't like to hold any money in the fund. Sometimes if there's variances throughout the year, they'll pay a special dividend at the end. But if they're seeing systemic, organic, sequential growth, they'll increase the dividend to pass that money straight back on to the shareholder. Yeah, so that does it for part 3. I know this was a long one. I hope you guys enjoyed the video. Let me know if you guys own any of these stocks, or interested in any of these stocks. And I'll see you guys in the next one. Please, if you haven't yet, consider subscribing to the channel. Let me know if you like the video by liking the video. Also, consider commenting on the video. Say hello. Say what kind of stocks you're invested in if you're not invested in these. Even if you're already subscribed, would love to just meet you guys. So yeah, see you guys in the next one.